Hello, my name is Terry Bryan and I'm a Member Services Consultant with Tasplan. Today we are going to talk about making additional contributions into your superannuation account. Before we start, however, I would just like to remind you that this presentation is of a general nature only and does not take into account your own personal situation. Should you ever require personal advice, we always recommend that you speak with a financial planner. As a Member Services Consultant, I talk to members every day. And one of the first things they ask me is, when can I retire and how much do I need in retirement? The conventional thinking here is that if I don't have over $1 million in super when I retire, I'm not going to have a good retirement. But this is not necessarily the case. There's an organisation called ASFA, A-S-F-A, which stands for the Association of Super Funds in Australia. Now, ASFA release what they call a retirement standard, and they update this standard every 3 months. And what they say is this: if you want to retire at age 65 and have a comfortable retirement for around 23 years, then as a couple you need to have approximately $640,000 between you. For a single person, that goes down to $545,000. Now, along with that figure, ASFA provides a budget breakdown of expected after-retirement expenses. And they say that the $640,000 will give you a yearly tax-free retirement income of around $62,500 per year. Now, a lot of you are currently shaking your heads and thinking to yourself that you don't have or won't have anywhere near that amount in super. So I'm going to give you some simple ideas about growing your super with minimal effort. One of the easiest things that you can look at is making additional contributions into your account. On your screen at the moment, you can see 3 different types of contributions that can be made into super. The first one that I like to talk about are after-tax contributions or non-concessional contributions. In superannuation speak, after-tax contributions are any contributions that are put into your super account after tax has already been paid on that money. These could be things like money from a bank account, sale of an asset, or even an inheritance that you have received. You could put that money into your account and we will not tax that money any further. The tax has already been paid on the money before it goes into your account. The second type of contribution that we have listed here are what are known as salary sacrifice contributions. Now, salary sacrifice contributions are what we call concessional contributions or before tax contributions. These are contributions that are made out of your gross salary rather than your net salary. So no tax has been paid on that money prior to it going into your super account. Because no tax has been paid, the government requires us to tax that money at a concessional tax rate of 15% rather than at your normal marginal tax rate. For example, if you earn more than $37,000 but less than $90,000 a year, your marginal tax rate is currently 32.5%. But if you earn more than $90,000, then your marginal tax rate goes up to 37%. So if you are on the 32.5% marginal tax rate and you put money into super, you only pay the concessional rate of 15% or a 17.5% saving on what you would pay in tax. If you pay 37%, then it's a 22% saving in tax. And because you are paying it before tax, it reduces your gross salary, meaning you are paying less tax on a week-by-week or fortnightly-to-fortnightly basis. To give an example of this, say that you are earning, say, $60,000 a year. Option 1 has chosen to make an after-tax personal contribution of $115 per fortnight, while Option 2 has chosen a salary sacrifice, $175 out of their before-tax pay per fortnight. Based on the 32.5% tax rate, you can see that the end result of this is that Option 2 is now able to get $149 more into their super. That's an extra $34 a fortnight, yet both options still maintain their same take-home pay. The third type of contribution shown here is a spouse contribution. Now, there are a couple of different types of spouse contributions available. However, the one I wish to highlight now is the spouse contribution tax offset. This allows you to contribute up to $3,000 into your spouse's account, and provided that they earn less than $40,000 in taxable income during the financial year, then you can claim that $3,000 on your tax return to potentially get a tax rebate of up to $540 on your tax for that year. Now, this strategy is something that you should be talking to your tax accountant or financial planner about beforehand to make sure that the strategy is suitable for you. Now, with all these strategies, there are limits to how much you can and can't put into super. So for the before tax contributions or concessional contributions, the maximum amount that can currently be put into super in a financial year is $25,000. So the maximum you can do as a salary sacrifice is $25,000. However, you should be aware that your employer is also making contributions into your account, and they are putting in 9.5% of your gross salary. So this is also classified as a concessional or before tax contribution. So this needs to be included in the contribution cap. What this means is that if you are earning, say, $100,000 per year, your employer is already contributing $9,500 to your cap, meaning that you are only allowed a maximum of $15,500 of salary sacrifice. The second contribution cap is on the after-tax contributions, and this amount is limited to $100,000 per financial year. However, having said that, the government has what is known as a bring forward rule. This bring forward rule allows you to use up to 3 years of caps in one contribution, so that you can in fact contribute up to $300,000 in a single financial year, provided that you make no more contributions for the next 2 years. Always remember, if you have any questions about your account or would like further information on what you have seen in this video, you can call our contact centre on 1800 005 166. Thank you.